Good morning. I'm Joe Brusuela, Senior Economist at Bloomberg LP, with your Bloomberg Economic Brief Morning Cup of Joe. We've got a very quiet morning in global markets here in the U.S. Equities look to open unchanged on the morning. The 10-year yield on U.S. Treasuries is exactly where it was when the market closed yesterday. I think the big thing here is, and what we're going to have in focus in this morning, is what's going on in global central banks and inflationary risks to the economic outlook. The Bank of Canada yesterday signaled that a rate increase may be possible due to improvement in growth prospects and rising inflation, whereas this morning we did see that Adam Posen, who's a member of the Policy Committee at the Bank of England, is backing away from supporting further quantitative easing due to inflation risks to the economic outlook associated with rising core inflation. And that's key because Adam Posen is probably the foremost dove on the MPC over at the BOE, and he's been quite vocal over the past year that additional quantitative easing may be necessary to support growth prospects in England and bring down the unemployment rate. His backing away, I think, may reflect an inflection point in England going forward. Now, it's very interesting. In many ways, the English economy is the mirror image of the Canadian economy. In Canada, we've got a growing economy, a sound banking system, and a strong currency bolstered by demand for oil and commodities. Well, in the United Kingdom, we've got weak growth prospects and inflation risk via the import channel due to a relatively weak currency, rising oil, and commodity prices. Now, this is very important because as we move forward here, we want to remember that the increase in asset prices over the past half a year, the great reflation play, has been in part due to the actions taken upon the G4 global central banks. Now I want to turn just slightly to talk about what's going on here in the United States. This morning in the Bloomberg Economic Brief, I do have the big picture slot this morning, and I'm talking about U.S. inflation expectations, and this is to begin the work up towards next week's FOMC meeting. Now here in the U.S., we have very little risk to the upside due to inflation, and that's despite the rise in gasoline prices, which have increased about 20% since the beginning of the year. I think we get to the point is that with 5.3 million workers still sidelined after the recession, and an unhealthy output gap of roughly 6%, and housing prices continuing to adjust downward in many areas of the countries, it's highly unlikely that inflation expectations will become unanchored anytime soon. Simply put, a lack of bargaining power on the part of labor and asset deflation in the housing market will limit upside risks due to inflation. Hey, this morning between 8 and 10 on Bloomberg Radio, I'll be co-hosting Bloomberg Surveillance with Tom Keene. I hope you get a chance to tune in. I'm Joe Brusuela, and that's been your Bloomberg Economic Brief Morning Cup of Joe.